This is the Monday Call, brought to you by New Zealand Funds. This week, our investment team, James Grigger, Mark Brooks, and Andrew Curtain join us to discuss the big events that have impacted financial markets this year and the opportunities they see for investors next year. After 2 weaker US CPI announcements, have we hit peak inflation, or is there more to come? What is the outlook for China and its pathway to reopening? Is Australia once again the lucky country with an unshakable economy? Where does New Zealand sit in all this? And why does NZ Funds believe an active multi-asset investment approach is more important than ever in this market environment? Our investment team will explore these questions and more in the last Monday Call for the year.
Good morning, everyone, and welcome to the final Monday Call for 2022. As I sat here just a few minutes ago trying to think about some really huge, insightful things to say for the last call of the year, something did spring to mind as Andrew showed me a rundown of 2022 in quite a succinct way. And they had lots of different stats and examples of why 2022 was difficult. But I think the thing that jumped out of the page the most was at the start of the year, the Fed fund rate, or the equivalent of the OCR in the United States, was 0.25%. The market was pricing in a December 2022 Fed funds rate of 0.8%. As we speak today, the Fed funds rate is 4.5%. So completely different and much higher than expectations. And really this, along with geopolitical events, has really set the scene for making 2022 one of the most difficult and volatile years since the GFC. And so on that basis, we are going to run through each of the different asset classes that we invest in. We're going to talk about where it started the year, where it ended the year, why we invest in it, most importantly, and also our views of that asset class in years to come. But I think before we get on to each of the individual asset classes, and as we reflect on 2022, I think we need to also remember why we are investing. And Mark, putting it straight to you, I think you described it perfectly. Why are we investing in bonds, shares, commodities, crypto assets, interest rates, FX? What is the purpose? What are we trying to achieve?
Thanks, James. Morning, all. Look, ultimately, at its simplest, people often are quite lazy. We're quite happy to leave money sitting in the bank, in cash at, these days, 2 or 3%, something like that, maybe a little more. But ultimately, to generate wealth over time, people need to take risk. And traditionally, they've done that in New Zealand through the property market, but that's still taking risk. They're moving out the risk spectrum. And if I sort of summarize our role and the role fact of our industry at its very simplest is ultimately to invite people and encourage people to grow their wealth by taking risk. And to do that primarily through investing in assets such as bonds and shares and other similar growth assets that have a return profile similar to shares. But in many respects, sort of coming back to your first point, James, any time you take risk, you are opening yourself up to volatility, to years like this. So sort of rephrase what we do in a different way. It sort of says, well, yes, we have to embrace volatility. It's the nature of our role, but it's also a matter of managing that as best we can in tough years. And that sort of gets managed across different asset classes in different ways, and in many respects has dominated this year, really.
Yeah, it comes simply to shares or growth assets over the long term will generate 8 to 10%, probably more 8%, and then that's...
Well, it even, go back a level. Yes, shares will do that, but actually, if you're in cash and inflation's high, you are going backwards. So people do need to ultimately take that step, and it's not easy, but that's our role to try and make them take that step over time. And in a 1 or 2 year time frame, that may be a challenging discussion, but over a 5 or 10 year time frame, that's going to be a much better result than being in cash.
And so it's a financial advisor's responsibility alongside their clients to make sure that they've got the right asset allocation. And that's an extremely important, almost the biggest driver of their returns. And then it's the investment team's responsibility to invest that the best way they can. and it's not going to be linear. And we're going to have years of ups and downs. The market's going to go up. The market's going to go down. The market in the early noughties after the tech boom went sideways for many years and really didn't produce those risk-adjusted returns anywhere near the expectations that people wanted, given what they were expecting from equities. So, look, it's been an interesting year, but one that we think really emphasizes the strategy that we use from the investment side of investing in multiple asset classes across a number of different geographies in order to generate that return and also provide capital stability during really volatile periods of share market returns, but also provide that differentiated return, because although shares will be the biggest compounder of returns over time, we believe, there are points in time where there are other asset classes that can help you, especially in periods of high inflation. So we've got a list of the different asset classes, and since we're talking about shares, and Andrew's got some great stats in front of us, which just reminds us of how difficult the year is. Should we start with shares, Andrew? So why don't we talk about New Zealand share market and say the US S&P 500? Where do we start the year? Where did we end? And perhaps then we'll go into, what do we actually invest in this share class for? And perhaps we can talk about views as well, because it's been a roller coaster.
Thanks, James, and good morning, everyone. Why don't I kick off with why do we invest in shares? And I'm sure you might have some comments to add to that. But if you step back, what you're doing in investing in shares or the share market, you're investing in the largest and most successful companies listed in each country around the world. So whether it's in New Zealand, you're investing in the NZX 50 or the top half of the companies of the NZX 50, these are the largest, most successful companies in New Zealand. And if you look to the United States, you're doing the same thing. Some of the key indices you might invest in is, say, the S&P 500, which is in general the 500 largest companies, which includes all the companies that people would know, such as Apple and Amazon and Microsoft, which have been very successful over a long period of time. Now, why do we invest in these companies? Well, these companies have shown that over very long periods of time, they can grow earnings at well above the economic growth of any individual country. So if the gross domestic profit growth, or the GDP growth of a country in the world, is 2 to 3%, well, what typically happens with these successful companies is they are growing their earnings at levels of, say, 7, 8, 10%. Some of the higher growth companies might be growing earnings at 15% per year. And so all else equal, you just put valuations aside for the moment. Over a longer period of time, you are going to generate a return on your investment more in line with the earnings growth of these companies. Now, pretty much whatever market you look at around the world, whether it's in North America or New Zealand or Australia or in Europe, the long-term returns over sort of 50, 80, 100-year periods is around about 8%. In the share market. If you look into sort of a 10-year period of time, those returns will tend to sort of move towards that 8%. They might be a little bit above for some periods. They might be a bit below, but the longer you get these sort of these returns around that level. And that is because that's round about the level that earnings of these companies can grow over a long period of time. And so that's what you're doing. You're buying a slice of these successful companies so you can share in the growth of these companies. So that's why we do it, and that's why it's a strategy that has proven over decades of financial analysis and history that you can get these returns. Now, if we jump into the shorter time frames, this is where the returns can be much higher or much lower than this 8%. And I think there's probably been really no better sort of example of this than over the last 3 years. So just to sort of set where we came into this year, we came in after about 18 months to 2 years of very, very good share market performance. The market fell by about 30 to 35%, depending which market you're looking at, in early 2020 when COVID came onto the scene. This was followed by a very strong rebound, and the year actually finished quite positive for most markets. That was the end of 2020. So even though we were down 30% at one point, most markets finished, say, up 15 or 20%. This then carried on with another very strong year in 2021, where most markets went up by another 20 to 25%. So you'd had a great 2-year period of returns, albeit with a very sharp down period or period of volatility in early 2020. So we started this year with pretty much every market around the world having had good returns, but valuations were trading at very high levels. The price to earnings multiples of, in most markets had got to levels of about 25, 27 times. In fact, the New Zealand market even got to a level of about 30 times, which historically is the highest that was seen in the NZX 50. Now the period that comes close was early 2000. Now, what does that mean? Well, that means it gets very difficult to sustain this valuation multiple. You don't tend to stay at these higher levels. And so that was the start of the year. We came in after a period of good returns, but a period of high valuations. I might just pause for a second just to see if Mark or James want to add any comments to that before we sort of go into sort of what's happened and recap the year in share markets.
I think the one thing I'd say about valuations is high valuations can stick around for quite a long time. I think we've seen it in the Auckland housing market where valuations have always been described as too high, but you never really know what the catalyst is. And the risk about being overly bearish, say if we were overly bearish at the start of the year, is there could be a whole host of reasons why those valuations could, worst case, stay where they are, but best case, stay where they are. Worst case, if you're overly bearish, is they keep on increasing because of some reason. Maybe interest rates go down even further because inflation's low or whatever it is. And so you might be bearish on valuation alone, but you also have to be cognizant of the wider macro piece, but also cognizant of what the market's telling you. And at the start of the year, I think we were relatively bearish on a valuation basis, but there was no real catalyst to really change that until the obvious one came about.
Inflation and higher interest rates. That is right. So I guess if we roll through the year, we had the US market and the New Zealand market. So the US market peaked on about the 2nd or 3rd of January, so right at the start of the year. The New Zealand market had peaked a number of months before that. There are a few specific things that was going on in the New Zealand market, more just on an individual stock or an individual company nature that led to a peak a little bit earlier. But most of the markets around the world peaked right bang on at the start of the year. Now, this was obviously after a year that had been very successful for most markets, and now the forward-looking attention got looking towards inflation and higher interest rates. And that's typically, in the short term, not a great setup for the share market. Companies don't tend to like higher interest rates. Just the same way that if your mortgage rate doubles, you tend to pay less for the next house you're going to purchase, or the housing price tends to come down. It's a similar effect to the share market and companies. And so what proceeded to happen was a long, drawn-out bear market. I say long because it's been going now for around about right through the entire year, so 11 and a half months. It's obviously much longer than what we saw in March 2020, which was over in about 8 weeks. And if we just sort of step back and look at sort of where the major markets that we follow are, we've got the S&P 500 is down 18% for the year. The NASDAQ, which is the technology-heavy part of the US share market, has had a very, very poor year, down 31%. The global sort of developed market index is down about 18%, so similar to the US market. However, down in our corner of the world, we've actually done a little bit better, which is pleasing to see. So the NZX 50 is down by 11% for the year. And the star performer is the Australian share market, which is up by 1.9% for the year. So that's kind of the layout. It's been a volatile year. Within that, we've had lots of ups and downs. It's not been a smooth downward year. In fact, one or two data points I think might be interesting. In the S&P 500, there were 60 days where the market was down by over 1% in an individual day. Now, we've not seen this happen since 2008, which was the worst year of the global financial crisis. On a volatility perspective, or just sort of the overall daily movement in the share price in the US market, it is the 5th most volatile year since the World War II period in 1942. So the other periods that has sort of exceeded this volatility was 2008, 2009, actually 2020, which was concentrated in the start of the year, and 1987. So just from a sort of context point of view, this has been a highly volatile volatile year. But at least we're seeing some sort of brighter spots, such as the NZX 50 has outperformed a little bit more, and the Australian market has outperformed. So where are we sitting today? Well, if I look at valuation point of view, the US market has come back to around about its long-term valuation. So that's a price to earnings multiple in that sort of 16 to 17 times area. That's the multiple it's traded at on average over the last 20 years. Now that's a good sign. That's a positive thing. That shows that we've basically removed that excessive valuation we saw over the last 2 years. If we look at the New Zealand market, we're still trading a little bit expensive. We're trading on a 22 times multiple relative to our long-term average of about 18 times. So the market's been willing to pay a higher price relatively for the New Zealand business throughout this period. That may be reflected of that. We've got quite a few defensive type nature companies in our top 10, such as the energy companies, such as your sort of Genesis and your Meridian Energies or your Contacts, companies like Auckland Airport, which are stable, long sort of duration and safe cash flow companies. Spark, these companies tend to trade on sort of slightly higher multiples. So that might be a reason for that. And then onto the Australian market, which has performed really well. It's really a reflection that it's heavy in resources. Commodities, which we'll touch on later in this podcast, have done very well. And that's really supported the Australian market throughout this year. And the other part of the market in Australia that's done well is the banks, and a large portion of the index is by the major banks such as CBA and ANZ and Westpac, and they've done relatively well this year in an increase in interest environment.
Yeah, I think that when you summarise the share market and the volatility that we had, it has been a rough ride. But when you think about it from a long-term perspective, there's actually starting to be some companies that look quite interesting, and I think that's really going to be the focus of next year, isn't it? Where there are still companies that perhaps are overvalued, and there are companies that perhaps aren't going to do well in the environment that we think we're going to go into, which could be a bit tougher on the economic conditions and maybe unemployment increases, et cetera. But there'll be some companies which are a lot cheaper than they were at this time last year, which starting to look like an interesting proposition to add to the portfolios, and a real opportunity to buy some fantastic franchises at more normal rates. And I think you can be quite positive when you think about US markets. I think New Zealand, there's that great tax efficiency, and the New Zealand market perhaps isn't a good reflection of the New Zealand economy because, as you said, Andrew, it's got these great defensive assets. People are going to buy electricity no matter what's going on in the economy, maybe get a little bit decrease in demand, but not really. And some of the growth companies within the market, New Zealand market, are perhaps more globally focused anyway. But when you look at and so with a decrease in housing and perhaps a tough aspect for consumers in New Zealand, maybe we do have a tougher time in the New Zealand economy, but the New Zealand market might be able to be quite stable. US is a bit different, isn't it? The consumer looks like they're in pretty good shape. They're all on 30. They're all on. It's a big call. Most people in the US are on 30-year mortgages. And that means when interest rates go up, the cost of living doesn't really increase to the same extent as it does in New Zealand because their mortgages don't roll on to higher rates. And so that consumer actually looks pretty strong. And I think the thing that's caused the volatility, why we and the rest of the market participants are sitting here relatively exhausted from a volatile year, is the whole market is trying to decide where interest rates are going to go. And while that affects New Zealand greatly from a housing market point of view, it affects New Zealand less on the shares. But in the US, yes, it affects some consumers. Yes, it affects businesses. But the consumer is going to remain strong because that mortgage rate really doesn't change. And so lower valuations, a strong consumer. Maybe we've come to the end of the aggression in the rate rising cycle. It's going to be a pretty interesting year to find some great companies. So I think it's also a good segue into bonds, because bonds at the start of the year looked terrible as well. If we remember and just remind everybody, and I have to, as an equities guy, I have to remind this to myself often, that when bonds are doing really well, it means their yields actually go down. So interest rates, as bonds get more expensive, their interest rates go down. And so at the start of the year, Mark, you're buying a corporate bond, getting an interest rate of what?
in the US, you were looking at somewhere around about just over 2%, 2 and change. Now, for an investment grade name, you're looking at probably mid fours. For a high yield name, you're probably looking at 8%.
So totally different investment environment now. So maybe we can talk through that. Why are you even looking at bonds, and how do we go through the year?
Yeah, I'm going to probably start by sort of wind it back to sort of that point of what we're trying to achieve and what the role of bonds are. And I'm going to steal something from one of our private wealth advisors who sort of had the very nice analogy that bonds, in many respects, in a portfolio, sort of act as that keel that you get on a sailboat. It really is there to ultimately provide that stability and generate return, but provide stability against those assets which are probably dominating more of your output in terms of, or the speed of the boat, etc., sort of being shares and other assets like commodities. And typically, what is important about bonds, just because of that sort of pricing aspect that you said, is typically when the world is a challenging place, bonds do well. Interest rates go lower, so bonds tend to do well. What has been, I think, misunderstood or really poorly reported this year is there's been a very unusual year where you've had share markets have negative returns, and you've actually had some deeply negative returns in the bond markets. And if you had sort of such poor returns that you've had relative poor returns that the bond market have seen in share markets, it would have been front page. But ultimately, people, I should say, reporters find it difficult to express that in a nice, succinct soundbite, so it tends to get overlooked. But just to put it in context, in terms of, say, the New Zealand government bond market, that's down, 8.5% this year to date. Corporate bonds have been better; they're down sort of 4%. And if we go to the US corporate bonds are down. They've actually performed quite well over the last 6 to 8 weeks, but they're still down 12%. So numbers that were ultimately in the region of sort of drawdowns that the share markets have seen. So you haven't seen that sort of that traditional stability that you'd expect from the bond market this year. The pleasing thing is that, from our point of view, we've been able to sidestep a lot of that, and the returns in the bond portfolios are up somewhere between 10% and in terms of our global portfolio, close to sort of over 17%. And really, that is nice because it means we've been able to sort of still provide that stability to clients' portfolios, while other parts of the portfolios have been more volatile. But coming back to your original question, James, why do we want to invest in bonds? Well, I think, look, again, with that stability aspect, every once in a while, bonds are a situation where you do actually need to step aside and let the market do what it's done this year. And we're pleasingly, as always, with a little bit of luck, but pleasingly be able to do that. But 98% of the time, you want to just own bonds and you get a yield off them, and that's the real ability of them being able to generate a return that's better than cash. You're taking a little more risk, getting a return better than cash but that is repeatable and stable. And I think the nice thing now is, as we said a year ago, the return you were getting was not much at all. Now there's actually there's a good universe of returns to be had from local corporates, again, those utility type names, etc., international, high quality international corporates, and then even going to some of the riskier sort of high yield names. They were giving you 8-9% returns, which are equity-like returns almost in some terms.
I think the other thing to remember is, as when share markets go down or a share price goes down, doesn't mean to say the company has gone bust. Just the valuation has changed because of prospects of the individual company or the markets. It's the same with bonds. When you're talking about US corporate bonds down, over 12%, the default level has been non-existent.
Correct.
No company's defaulted. It's more, I guess, the opportunity cost of higher interest rates compared to your bond portfolio. And so I guess what that means when I think about it, again, from a real simple brain, when I think about bonds, is that we've provided capital stability, if not positive returns in the bond portfolios. And now we can buy these great companies' bonds at a much lower rate and watch them rise in value again.
Yeah, and I think, again, coming right back to that initial concept, if people are sitting in cash, yes, they're getting a better return now than they were, say, a year ago, but inflation is still out there. In an environment where inflation's high and cash levels are high, you need assets that actually generate an income. I think, well, looking forward, I think assets that generate an income will do well. Whereas in a world where interest rates are super low, you don't necessarily need that income. You can focus more on that sort of capital return aspect. So in that scenario, having a large chunk of or a decent part of your portfolio generating a nice stable income, be it bonds through the coupon they pay, or be it sort of dividend yielding shares in New Zealand, which are, is the luxury of the New Zealand share market, really sort of provides that nice, reliable income stream to start with. And then if you get capital gain on top of that, that's the icing, I suppose.
I don't mean to go on about the property market because it's all asset classes are good to have in a diversified portfolio, but that point about yield and returns and becoming more important than capital at the moment as interest rates go up is a great one when you think about property, because all of a sudden the yield is important, and getting 1 or 2% yield in a investment property all of a sudden is probably not good enough. And so how do you get that increase in yield? Well, either your rental needs to go up, which is going to be difficult, or the price needs to come down. And so that's what we're seeing there. And we've kind of already had that in bonds. And so the market has kind of already moved in the listed markets, and it just takes some of the unlisted markets like property a little bit longer to get there. But when I think about the opportunity set within bonds, it is exciting. The other thing, I guess, and this is probably leading on to maybe we can touch on views around interest rates now. But when I think about shares, and when we go through a period like this, and we can talk about all the different things that have caused it, whether it's geopolitics and the war in Ukraine, or China growing or not growing and then growing again. But then when you look back on a year like this year, or you look back at the GFC, or you look back in 2020 post the sell-off when markets started rising vigorously again, really it's interest rates that are telling you what's going on, and everything else is kind of a secondary to. If rates are going up, growth assets struggle. If rates are going down, growth assets do better. And if rates are stable, then really the share market and other growth assets will bob along. And that's kind of what's happening.
And that's a really nice segue, because I think, for those who have been listening to this call throughout the year, we have, certainly from the start of the year, been banging the table. Interest rates needed to be higher. That was likely to have a major impact across all markets. Interest rates are higher. If I look through the list, 2-year US interest rates were 73 basis points at the start of the year. They're now 4.2%. The 10-year rate was 1.5%. That's now 3.5%. In New Zealand, the 2-year rate was a little over 2.2%. It's now 5.3%. So they're all dramatically higher. So that that sharp move has happened. And broadly, I think that's the word, has happened. There is certainly, there's always risk that they need to go higher. But a view now would be that we've seen the bulk of interest rate rises, and more likely we're in a range at these sort of more elevated levels. And if you're in a range, that reduces the sort of potential good and bad outcomes. Again, comes back to that issue of you probably just want to own assets and harvest that yield, and especially bonds where you can harvest that yield.
And I think those turning points are the really hard part. So at the start of the year, the turning point happened 3rd of January, Andrew, and we were positioned really nicely to take advantage of that, because we were really nervous about what was going on in the world and especially in share markets. But that turning point in November, where perhaps the financial markets decided that, yes, we've probably had enough interest rate rises for now, or the interest rate rises, should I say, are priced in. And you do get those turning points. You do get big changes in volatility as the market moves. So all of a sudden, 10-year interest rates came down, currencies moved vigorously, and you're not always going to get those turning points in a volatile market. We experience that because we've able to ride this wave of great interest rate increases and share market coming down. and those turning points mean you do give up a lot of that, but a lot of those gains at the point. But then you recognise what the new regime is, and go forward and generate returns from that point on.
Yeah, well, I think for investing, that's where the art is ultimately. In that, still investing is about humans, people. Yeah, and ultimately people's sentiment. And sentiment is such a big driver. If we look at, say, what's happened in the domestic property market, yes, there are fundamental reasons why property market should be soft. Interest rates are higher, inflation's high, et cetera, et cetera. But, why does it turn quite violently at different points in time? Is that because sentiment changes and something changes that? And I think a really good analogy actually, or sort of data point, is looking at US inflation. US inflation today is 7.1%. US inflation December last year was 7%. Not vastly different, but the views of the world are quite different. And to be fair, interest rates are at a different level. But it's probably worth characterising that sort of prior to November, we were still climbing an inflation hill. I think generally markets and people think that we've crested that hill and they can see the sort of the green valley below, for want of a better word.
The beginning of the end. Andrew, another asset class that has been an incredibly difficult, but I don't know how to use it other than what word to use other than exciting asset class in the sense of the movement and the volatility, has been commodities. I think I always go back to the article that you authored back in 2020 around the commodity super cycle to remind myself, but also listeners, that the commodity super cycle isn't something that just came out of what's happened this year, especially in Ukraine and some of those geopolitics. Actually, it's a long-term trajectory that we believe is happening because of, I guess, decarbonisation. But that's the key reason why we're in commodities, and it's a supply and demand offset that's really going to take some time to get right, and we're going to see price increases. But tell us about how commodities have gone. Maybe we can talk about some of the key attributes of some of the ones that we're invested in at the moment. But
yeah, just to kick off on that super cycle comment, just to quickly remind people what we mean when we talk about super cycle. It's we're not talking about a 6-month view or even a 1-year view in commodities. You're talking about a sustained view which you measure over multiple years and really sort of that decade-long period. And throughout history, there's been a number of super cycles in commodities. It's generally been demand-driven. It's generally been that there's been a big step change in demand, which has led to a sustainable period where countries or companies or businesses and consumers have had to spend more money on raw materials. An obvious example would be World War II. Massive demand expansion for infrastructure, for obviously weapons and vehicles and everything that needs to be built to sustain a war. The most recent example, sort of prior to what we're talking about in the last year or two, would be when China came onto the global trade market in that sort of period of around sort of 2000, 2010. It wasn't just China, it was Brazil and it was other big developing nations, which really just supercharged demand because they started trading cheap products around the world, and it caused a sustained boom across multiple commodities. And that's what we're excited about at the moment in the current commodity landscape. And we've got a little bit of a double whammy here, where we've got both what we believe is going to be a sustained demand period, but also an undersupply. So we're sort of getting, what makes a commodity price go up? Well, it's either demand increases or supply decreases, and potentially you can have both. Now we're taking the sort of the 5 to 10 year view. So what's the great demand setup over the longer term view? Well, renewable energy is a very, very large driver of this. The world has committed, and when I say that, most major governments have committed to meeting certain standards around emissions. They have certain checkpoints along the way where they want to get to by 2030, 2040 and 2050. By and large, this means they need to significantly reduce the amount of fossil fuels they're using to produce energy. They need to build more renewable forms of energy. Leading the way is energy such as wind and solar. In some countries, it's hydro. And of course, nuclear is becoming a much bigger part of of energy production and sustainable sort of energy production, as it provides that sort of core baseload energy production. So this is a big long-term driver. But then combined in the short term, we've really had uninvestment over the last sort of 5 to 10 years since the last commodity cycle. So a lot of products around there, whether that's oil wells or in some countries gas, in some countries or many countries around the world where copper's produced, it's been underinvested. And so if you step across sort of many of the core materials that go into basically funding infrastructure and funding renewable energy, it's been underinvested for the last 5 to 10 years. And so that has provided a great platform. And what excites us about commodities is they can be quite uncorrelated with bonds and shares. So they can provide a really good alternate investment in the right environment to generate positive returns when other asset classes are negative. Now, as we've talked about, shares this year are down anywhere from 15 to 20%. Bonds are down, call it 10% or 10 to 15, depending which market you're looking at. The commodities index as a whole, this is the Bloomberg Commodities Index, which is a sort of a measure of all commodities and in terms of how much people generally use them, is up around about 15% this year. And this is actually at a slightly weaker point. At one point during the year, it was up around 30 to 40%. Some of the key products: oil up 34%, natural gas, depending which market, but looking at the US spot price is up over 100% this year. We've seen iron ore go up by around about 40%. Corn's up about 45%. There are some specific drivers on some of these products, such as Ukraine war, which really has pushed up the price of natural gas and corn. People have their different views on what it's done to oil, but probably as a whole been positive to the oil price. But really, this has come on top of what was already a positive setup for commodities.
And it's not just the commodities either, is it? I was just looking at Bloomberg as you're talking and thinking about some of these commodity shares are really volatile, yet Cameco, the uranium company that we've been invested in for a number of years now, flat for the year when the market's down almost 20%. ExxonMobil up almost 80% year to date. So it does feed through into some of these companies as well. And if you think about some of these indices and, the S&P down 18%, if you strip out some of these commodity companies out of that index, that's going to be a lot worse. And that's why it perhaps for some portfolios, investment portfolios, feels even worse than the 18% because they don't have this commodity mandate that they can invest into, I guess, at least give you some stability, if not, positive increases.
It's absolutely right. I haven't checked the sector numbers for a few days, but I believe the energy sector of the US market is the only market of the share market that's been positive this year, and that's really because it's benefited from that higher oil price. Another company that we've invested in, which is up over 80% this year, is a European listed company called OCI, which manufactures commercial fertilizer of all products, nitrogen-based fertilizer. And given the sort of that food crisis we've been going through and the importance of growing and having great yields in crops such as corn, fertilizer companies have done really well, and it's just traded completely on its own fundamentals, irrespective of what's been going on with interest rates and the rest of the market, because there's been a need for its product. So that's a good point, James.
What's interesting with commodities is it's the same comment I sort of always reflect on when I said shares. When you look at it, it's really interest rates. It's kind of the same with commodities, but second order a bit in the short term I'm talking about. So volatility in commodities is real, and there are some periods where it is going to hurt owning commodities, and that's going to mean that our performance will differ from the share market. But this isn't a 6-month view, like you said at the start. This is a 5, even a 7, 10-year view. But when you think about some of these commodities, they really do get affected in the short term by the US dollar. And so interest rates going up, strengthens the US dollar, and it's a bit harder for commodities because everybody's buying them in US dollar. Then all of a sudden, interest rates perhaps are at their peak. US dollar weakens, commodities go up. It's sort of like a bit of whack-a-mole in commodities in the short term. And really, what we're trying to do with this asset class is identify the ones that we want to be invested in over a number of years and set and forget. But that can create some volatility intermonth when you have big changes that we've seen in interest rates and currencies.
That's exactly right. I think maybe a good example recently of short-term volatility would be the oil price, and China, had the recent sort of announcement they've made about reopening and starting to get their economy travelling again and out of lockdowns. And initially the oil price shot up, and then the oil price reversed and started coming down. And there were a number of drivers for this, but one of them was, well, in the short term, if they're going to open up and stop locking down, then they're going to have everyone with COVID in hospitals, and actually the activity in China might decrease over the next couple of months. So oil price came back down by about 10% or so. And so in the short term, it's very, it could be very, you get a lot of these movements, but what we're trying to do is try to take out a bit of that noise and look at that longer term sort of period of why we're invested in this asset class. And certainly this is one of these longer term cycles, which you do see every couple of decades, that we believe is an attractive time to be involved in commodities, and certainly provides great opportunities, maybe relative to when other asset classes might not be performing quite so well.
And that's a good segue, Mark, into FX, which is this is real crystal ball gazing here. But I think when we think about FX, it's not why are we invested. I think FX is an outcome by being invested in global markets. And it's something that you can either hedge your portfolios, it's something you can get an exposure to, because that's what we call it the outlet valve is sometimes currency, especially in volatile periods. There's a flight to safety to the US dollar, for example. But other attributes of currency we've seen, especially in the New Zealand dollar, is I think you charted the New Zealand dollar versus the S&P 500, and you could almost not tell the difference between the two lines. That's how correlated they are.
Yeah, and for that reason, I'm probably not going to answer your question. FX is always really hard, if only because a lot of assets have, as Andrew said, maybe in the equity space, you can come back to company earnings and really work out a fundamental valuation. Yes, you can have a similar approach in FX. There aren't earnings, but a country, you can come back to the performance of a country and how that's doing. But the impact of that can be over a very long term. So in many respects, FX can be a little bit of a fashion item, what people concentrate on as in terms of driving it. And if you look at, say, the New Zealand dollar this year versus the US, we started at sort of just over 68 cents. We moved all the way down to a low of 55 cents, so a big move. And here and now today, we're just below 64 cents. So almost sort of round tripped that path. And, there are reasons why New Zealand dollar should probably be strong relative to other currencies, in the sense of our interest rates are generally pretty high, not as high as the US now, but generally pretty high. In terms of trade, the rural sector has had a positive New Zealand has had a positive terms of trade shock with what is happening in terms of global agricultural prices. So those are positive, but at the same time, at a shorter term level, a lot of what happens in New Zealand is frankly kind of irrelevant. And New Zealand dollar is a risk on, risk off asset. And as you said, if you chart the short term performance versus the S&P 500, surprise, surprise, that low at 55 cents versus the US dollar was about the same time the S&P 500 saw its low for the year, almost to the day. And we've seen a pretty sharp move up as a result, along with more positive views around US equity markets. So going forward, if you've got a view on equities, you've probably got a view on currency.
I think it's a great way to discuss an incredibly difficult asset class, and it's why so many of our competitors go, it's all too hard, let's just hedge it back to New Zealand dollar and not have to make an active decision. And I think there's some merit in that when you have the volatility in currency, but I think it is an asset class, and we all agree, talking for both of you, but I think you would agree with me. It's one you can't ignore. You have to be conscious of what it's doing, and especially if we think about I just take a step back and think of the KiwiSaver market in New Zealand is going from 80 billion now to $1 trillion by 2040. There is not enough room in the New Zealand market to invest. We have to go global. The New Zealand investment market, the KiwiSaver market, has to go global. And as soon as you go global, you're making a currency decision. And so to be agnostic about currency is not the right approach. You have to consider what that asset class is doing and be active and think about the investment decisions that you make within the more traditional asset classes of shares and bonds with a currency bent. And I think that's really important, and that's what we'll continue to do, albeit with volatility. I think that the next and perhaps final asset class that we'll talk about today is cryptocurrency. And why we specifically talk about cryptocurrency, I think, which we see as just another currency or just another commodity, depending on which organization you are in the US. But the reason we wanted to bring it up is because it is topical and it is something that we do invest in. And I think taking a step back and thinking about why do we invest in cryptocurrency? Well, the way that we look at it is that the payments system globally is being disrupted by blockchain. That is just without a doubt something that is happening. And why is it being disrupted? Well, for any of you that have sent money, as simply as sent money overseas to friends and family, the friction or the cost of that is incredibly high. The bank charges, the spread between the currencies, the time it takes, it is just asking to be disrupted. Or if you own a retail store and the amount of money it costs for someone to use PayWave when they make a purchase. It's simple things like that where without banging on too hard on banks, because banks are an incredibly important part of the economy and we have banks in our portfolios, they are making incredibly high amounts of revenue, profit and margin from payments. And so that really birthed cryptocurrencies. Then when you think about it from a more geopolitical perspective, you're also in an asset class that perhaps takes the pressure off your wealth away from government decisions. So think about, without spoiler alert on the World Cup, think of the winners this morning, Argentina. Fantastic football team, was a wonderful game. Their inflation in Argentina is about 100% at the moment. And 100% inflation has huge detriments to people's wealth, because if your wealth is sitting in Argentinian currency, it is decreasing fast in value. And so that gives people an opportunity to diversify out of that into other currencies. But the problem is there's restrictions on buying US dollar if you do live in Argentina. So what's another way? It's cryptocurrency. So those are just two very, very small reasons why we think crypto assets and blockchain over the long term are going to be a massive part of the financial market system. The catalyst to invest in 2020 was uptake from institutions and the fact that we could then hold some of these in custody with big institutions like Fidelity and other banks. And as institutional uptake increased, the price and the demand for the asset class went up. But the volatility this year has been caused by the fact that it is a new asset class and one that desperately needs regulation. And we think regulation is going to be a really positive outcome for crypto assets, one that we're hoping happens sooner rather than later, and it will certainly be led by the US. And the pricing of cryptocurrency will become a lot more stable. It'll be another asset class. And importantly, you'll have organizations like Goldman Sachs, like Credit Suisse. Maybe that's not a good example. They're not perhaps as stable as they once were, but these big banking organizations will come in and be able to facilitate the buying and selling of these asset classes in a regulated and more robust manner than what we've seen with some of these exchanges like FTX. And I think the important thing about what's happened with crypto this year is absolutely nothing bad or wrong or concerning has happened to the underlying asset classes. Bitcoin has done exactly what it should in terms of the technology and the blockchain. Nothing's been hacked. There's been no loss of Bitcoin because of the technology. Same with Ethereum and same with all these coins. Where the problem lies is the regulation of the exchanges. And the exchanges are the ones that are the organizations that have lost people money as investors have left money on the exchange and their accounts on the exchange, and those exchanges have actually been using that money for other things. So regulation, I think, is the key word for crypto assets. I think regulation of exchanges will happen a lot sooner, maybe soon into next year, and that's really positive. In the meantime, we continue to be curious, we continue to learn, and we continue to take advantage of opportunities within the space when we think that the prices have stabilized. And actually, the asset class is looking incredibly interesting at the moment. It's been in a range that has been quite stable for a number of weeks now, and given where our views are around shares and where we think that those assets can potentially move to now that interest rates have got a lot less volatile, crypto assets are also looking quite interesting that we're going to do a lot of work on. But to give the numbers, I guess, Andrew, you've got the charts there. They look pretty dire. What's happened within that space?
Yes. The first thing I found interesting when I looked at these charts, because I've been looking at the mega cap tech stocks over in the US a lot as well, and so they're companies that we're getting interested on from a research perspective. And what I was actually surprised me is that Bitcoin is down for the year 63%, which is obviously a very poor return. But just to give this in some context, to some of the largest technology companies on the share market this year, we've had Facebook down 65%, Amazon down 58%, and Google was down 40%. So just to put in a little bit of context, it's been a very tough year for crypto and Bitcoin, but we've seen similar sort of negative returns across the whole technology company space. In fact, if I sort of look at some of the more speculative technology companies, they're often down 80 to 90% this year, and Ethereum is similar to Bitcoin, down 67% this year. So what you've really seen is that the crypto assets have traded like the riskier end of your technology company spectrum this year. Or in fact, I wouldn't even say companies like Facebook and Tesla are at your riskier end, but they're down similar levels. But it's sort of, to me, that's been driven, as James sort of started, it's this risk-off sort of environment, high interest rates. People are sort of looking to hoard their capital rather than spend it on risky assets, and it's traded in that sense. And I think, as James was alluding to, sort of as you start to see this interest rates peak and maybe even start to decrease in time, it's certainly positive both for technology companies and for the crypto space.
And the important thing with a new asset class like this, I think in our investment lifetime, I don't think we'll see another new asset class. They don't come around too often. But as they develop and grow in popularity, but also in robustness and regulation, it will be volatile, and it's important to have the tools to be able to invest in it, but also hedge it. And the fact that we can completely hedge out and de-risk our crypto exposure when things get volatile means, yes, it's fallen 63% in Bitcoin's case and 67% in Ethereum. We don't need to be there, and we haven't been there for those big drops. And that's been through being able to have the setup where we can hedge those risks. And it is an incredibly liquid asset class, far more liquid than the New Zealand share market, for instance. And so we can change our positioning relatively fast. But when it's volatile like this, we don't need to be there. And that's an important part to remember when we see this volatility. I think we've covered a number of different asset classes. We're closing in on the hour, and Andrew and Mark don't realise I'm going to ask them this, but thought I'd give them each a chance to sort of sum up what they're most excited about, or worried about, or interested about for 2023. Mark, perhaps start with you.
I think probably the setup at the moment for my space is just remember to own assets. There are different points in time where you want to be really active, and this was a year to be like that. As we go forward, it does look like inflation is coming down in the US. So I think initially, the first part of the year, we'll be looking to own bonds, own credit, just harvest, as I said, harvest that yield that's available. What is interesting, I think what we're going to watch very closely is, we've talked a long time that we do believe that inflation is structurally higher. Things like deglobalization, issues like ESG and having to electrify the global economy, the fact that governments generally are still spending money, all of those things will keep, I think we're still strongly of the view will keep inflation more elevated than it was during the early 2000s. So we are talking a 3 to 4% number versus a 0 to 2. Having said that, the market is definitely of the view that inflation is coming down fast, and I think that's probably right, or at least in the US. But the challenge might be as we go through the year and we're starting to see some signs at the margin that actually growth may be accelerating or may begin to accelerate sometime around about sort of mid next year. And at that point, whilst interest rates are plateaued and probably in a range here and now, do we end up with a situation, this would be my left field sort of thought, do we end up with a situation where interest rates in the US have to go higher again? At the moment, that's not the market's view, but that's a left tail. Domestically is a bit harder, actually. I think we have a real challenge in New Zealand. Clearly everybody's seen the Reserve Bank be forceful in their discussion about they're basically saying we need a recession to bring inflation under control. The challenging dynamic here is growth. We had a GDP number out last week of 2%. At the headline level, that's we're 2% for the third quarter. Always very backward looking at New Zealand, and on an annual basis, 6.4%. Now these are real numbers, so you bring back in 7% inflation, all of a sudden you're talking actual nominal real dollar growth or nominal dollar growth of 13, 14%, which is almost emerging market like. It's kind of nuts. But the other interesting thing underneath that is actually, as I sort of said about terms of trade, etc., or pretty much all of that is external. It's coming through our exports and it's coming through tourism starting up again. I think domestic activity grew 0.1% for Q3 and was actually negative for Q2. So you've got a domestic economy that really is probably starting to go backwards, but counterbalanced by an export economy that's doing really well. So that's going to be a challenge, and don't kind of know where that may mean the Reserve Bank continues to have to be it probably means the Reserve Bank continues to be robust in their discussions, but we might get to a point around about middle of the year where things become much more challenging for New Zealand, and you find interest rates are doing the opposite and actually going lower versus the rest of the world might be moving higher.
Andrew, on to you.
I'll try to speak for 5 minutes like Mark did. So Mark had so many ideas, but for me, I think I might keep it quite simple, because I think what excites me the most is earnings of companies. So I use sort of the simple 3-point process where I sort of look to bottom of the bear market, which is what's happening with interest rates. Are they coming down or have they peaked? Where are valuations? We've talked about both of those subjects already today, so I won't repeat myself. And the third one is earnings. And earnings is the area where companies have earned excessive earnings over the last couple of years. That is starting to come off. So even though we're at good levels in valuations in most markets, or back to the sort of long-term levels, what's really kind of difference between different sectors is where their earnings levels are and what's going to happen to them over the next 12 months. In some sectors, we're going to see growth. Some sectors we're going to see earnings come down, and some areas quite significantly, particularly sectors that sort of benefited from that heightened demand. So their products were able to push through higher prices in the last couple of years, but are now starting to see a bit of pain from high wage prices, and their demands maybe starting to wane a little bit for their products. So for me, that makes it really interesting from the stock selection point of view. I actually think the US and Australia might be two of the areas where I'm going to be most focused. I think have seen the best earnings performance in both of those sectors, which is why Australia's performed particularly well. But segments of the US have done very well as well. So I think it's going to be a really good hunting ground if you can get into the weeds, understand what's going on with each company, understand which companies may see the earnings reversal, so therefore you don't want to own those segments, and which ones might see the earnings kind of stay high and benefit, and sort of Mark alluded to maybe an inflation environment that stays at 4% or so and benefit from that. So we've been doing a lot of work around that. The other part is technology sectors. As we said before, has seen a very large sell-off. There are segments within the technology sector that are now looking very cheap. So we're doing a lot of work around those companies. Again, trying to focus on companies which aren't going to see too much pressure on their earnings. We're trying to focus on companies that are cash flow positive. And so there's a lot of opportunity around there. The New Zealand market, I think, is the bit that makes us a little bit more cautious here is that as a whole, it is relatively the most expensive market compared to where it has been. So as I sort of said at the start, the multiple has stayed above its long-term average. Some of that for good reason, given some of these companies, but it means the hunting ground for finding super cheap companies is maybe a little bit more tricky. Doesn't mean we won't find them, and we've certainly got some good companies that have been doing work on and been increasing our size into recently. But we'll be quite select with how we look at the New Zealand market. We're going to try avoid these ones that have sort of had this quite good period and they've got the more expensive valuations. So for me, it's stock picking. That's what I'm most excited about.
Can I sort of have a crack at summarising both of our comments?
Go ahead.
A year ago, we were probably sitting here going, the world looks pretty challenging. Rates are low. We think they're going higher. Equities are expensive. We think that we're going lower. Now, says to me from comments I was making and what Andrew was making is, there are always questions on the horizon. That's by the nature of investing. But the opportunity set out there is exciting. There are lots of opportunities, be it being able to own bonds at good levels, being able to own shares at much cheaper levels and sometimes exceptionally cheap levels if we can do the work and find the right ones. So there's it just says there is a really exciting opportunity set out there for the year ahead, which is pretty exciting, really positive and exciting.
What I love about investing is it is all about the present and the future, and the past is the past. You can forget about it, and you look forward, and there's there's some really exciting opportunities, like you say. The comment that I wanted to make, knowing that my esteemed colleagues would talk about the excitement of the market is, what does that mean you do as listening to us talking about the financial markets? How do we navigate the fact that things aren't going to be plain sailing, but there's opportunity? And it's what Mark said at the start. We encourage everyone to stay invested. And the way that you stay invested is having the right asset allocation. And the way to do that is to get financial advice. That is the number one thing you can do to grow your portfolio. The second aspect of that is to continue to invest, to continue to contribute. Right now, we think is an amazing time to be adding to shares and bonds, maybe not on a very, very short-term basis. Who knows what the next 3 months are going to entail, but the valuations that you're buying some of these companies on now that we're invested in over the next 3, 5, 10 years look absolutely outstanding. And if you're trying to save for your retirement, these are the types of opportunities where you need to invest and should be investing, all in the context of the correct asset allocation, and that is all established through seeing a financial advisor. And I think those different aspects of the market that we've been discussing is why we, as an investment team, have the tools, the knowledge, the infrastructure to invest across asset classes to reflect the investment environment. But the number one thing you can do in order to really grow your wealth over time is to be invested and to continue to contribute. So on that last note, thank you everyone for listening this year. It's been a long one. It's been a volatile one, but one that we think that volatility in markets has been managed to the extent that we're well positioned for next year. If you do have any questions or comments or feedback on the Monday call, please let us know. We can only do things to make it better. We'll look at the flash technology we're now presenting from, and so it's only ever improving. But that's because of the feedback from everyone that listens. But until then, we're going to be back in February. Markets don't sleep. We'll be continuing to work all the way through, but we'll be back bright-eyed and bushy-tailed in February with a whole range of new guests and a whole lot of analysis and research and views on financial markets. And we really hope you can join us. So have a great Christmas, Happy New Year, and talk next year. And thank you very much to the team, Mark, Andrew, Stefan, the Alt production team, and everybody who's made this podcast this year a great success. So thanks, everybody.
This has been the Monday Call, brought to you by NZ Funds. New Zealand Funds Management Limited is the issuer of the NZ Funds KiwiSaver scheme. the NZ Funds Managed Superannuation Service, the NZ Funds Advised Portfolio Service, the NZ Funds Wealth Builder, and NZ Funds Income Generator. A product disclosure statement for each is available at nzfunds.co.nz. Past performance is not necessarily an indicator of future returns.